Greetings, everyone. My name is Kyle McClain, and I'm a partner and senior wealth manager here with Rame and Gorell Wealth Management. Today, we'll be covering one of my favorite tax strategies within the ExxonMobil Savings Plan, the Mega Backdoor Roth. This strategy gives ExxonMobil employees a way to turbocharge tax-advantaged savings beyond normal IRS limits in their 401k plan. If you or someone you know could benefit from this strategy or the other services that our firm offers, feel free to contact our team for a complimentary consultation, where we will review your financial situation to determine opportunities for optimization from an investment, tax, estate planning, employer benefits, and retirement strategy perspective. So, without further ado, let's jump into today's topic, the Mega Backdoor Roth. So, what is the Mega Roth? At its core, the Mega Roth is a tax strategy embedded within your ExxonMobil 401k. By undertaking a series of transactions, employees can make contributions beyond normal IRS limits for contributions to the plan. For instance, in 2026, employees can contribute $24,500, either via pre-tax or Roth contributions, with a catch-up contribution of $8,000 available if you'll be over 50 years old by the end of the year. The Mega Roth allows certain employees to add tens of thousands of additional dollars beyond these limits to the plan annually. Now, I'd like to take a moment to refresh everyone's memory on how pre-tax versus Roth contributions work for tax purposes. As I previously mentioned, for 2026, employees can contribute $24,500 to pre-tax or Roth, or some combination of the two. Pre-tax contributions, as we may know, involve making contributions before federal income taxes are paid. However, all of your contributions, as well as all of the growth on those contributions, will ultimately be taxed as ordinary income upon distribution. Roth contributions, on the other hand, are made after federal income taxes are paid, and therefore all of your future growth, as well as your original contributions, will be tax-free when they're distributed to you. The determination of whether an employee would want to make a pre-tax or a Roth contribution is entirely dependent upon their current tax rate versus their anticipated future tax rate. Concurrently with your pre-tax or Roth contributions, the company will be making a 7% matching contribution to the general account. This contribution is also pre-tax. Based on the contributions discussed above, the total going into a 401k for an individual maximizing the pre-tax contribution and making $300,000 a year is $45,500 from a combination of the employee's contributions as well as ExxonMobil's matching contribution. This $45,500 total is well below the IRS maximum contribution limit for all sources of contributions. That limit is $72,000 for those under the age of 50 and $80,000 for those over the age of 50. So, where can this $26,500 difference between the IRS limit and the other maximum contributions go? You guessed it, the after-tax account. So, let's discuss the tax features of the after-tax account, because they're a bit of a blend of the tax features of the pre-tax and Roth accounts. After-tax contributions, as the name implies, are made after federal income taxes have been paid from the funds. However, growth that occurs while inside the after-tax account will be taxed as ordinary income upon distribution. So you might ask yourself, why would I contribute to an account with no current tax bill reduction, but all my growth will eventually be taxed as ordinary income? This is because we don't intend to leave the funds in the after-tax account to grow indefinitely. The ExxonMobil Savings Plan allows participants to convert these funds from the after-tax account to Roth. And the best part, if funds are converted to Roth before growth occurs, this conversion can be entirely tax-free. Here's how it works. Once the normal pre-tax or Roth limit for contributions is reached, the employee may defer additional funds into the third repository within the plan, the after-tax account. Subsequently, these additional funds may be converted to the Roth conversion account, where you will enjoy tax-free growth until these funds are distributed during your retirement years. At this point, we hope it's becoming clear that this strategy can be an absolute tax home run for retirement savers. It's also important to note that most 401k participants outside of ExxonMobil cannot use this strategy. While some large companies do have this capability, if you look at all eligible 401k plans in the US, only about 3 in 10 offer the Mega Roth. Before we wrap up our conversation today, I'd like to draw your attention to a few important considerations surrounding the Mega Backdoor Roth. To better illustrate the tax benefits of this strategy, we'll compare an individual who fully utilizes the Mega Backdoor Roth strategy over their career versus diverting the same after-tax funds into their taxable brokerage account. Using the same numbers from the example above, let's say this employee contributes $26,500 per year for 20 years to a brokerage account. Assuming an 8% growth rate, these contributions will grow to $1.21 million over the 20-year period. This means that within the taxable brokerage account, there will have been $530,000 of contributions and roughly $680,000 of growth. Assuming a 15% long-term capital gains tax rate, this will result in over $100,000 of taxes paid when the assets are sold. If, instead, this employee utilized the Mega Roth strategy over the same 20-year time frame, all of the dollars could be distributed in a tax-free manner, resulting in over $100,000 of taxes saved. If you have a pre-existing after-tax balance within the savings plan or growth on recent contributions, you should be aware of the Pro-Rata Rule. The Pro-Rata Rule states that if an after-tax account contains a mix of contributions and taxable earnings on these contributions, any conversion or distribution from that account will be partially taxable, depending on the ratio of contributions to earnings. These numbers are different for everyone, so we absolutely recommend that you discuss the effect of any current balance that you have within the after-tax account with a tax expert who can help you understand the implications of any future conversions. Another factor worth being aware of is the conversion limitation. ExxonMobil only allows for one conversion each calendar year from the after-tax account to the Roth conversion account within the savings plan. This is an Exxon rule, not an IRS rule. In some cases, it can make sense to execute a partial rollover distribution of your after-tax account to your outside IRA accounts. This can be done twice a year, but the in-plan conversion can only be done once, so you want to make sure that you use these annual conversions wisely. The final thing I want to touch on is something that many ExxonMobil employees aren't even aware of. For individuals that we talk to later in the year or mid-year who have not started after-tax contributions, the ExxonMobil Savings Plan allows for a special one-time per year after-tax contribution. This allows the individual to write a personal check and submit it alongside a form to the savings plan to fill up the after-tax bucket. This can be particularly useful for employees looking to accumulate additional tax-advantaged retirement savings but have not reached the IRS limit for total employee and employer contributions, which again is $72,000 in 2026. Thanks again for spending some time with us today to learn about the Mega Roth strategy. At Raymond Gorell Wealth Management, we have over $1 billion in assets under management. And as a firm, we strive to serve as an effective one-stop shop for comprehensive retirement planning. Our team of CFP and CPA professionals specializes in helping clients take advantage of advanced financial strategies to materially enhance their ability to enjoy their life both before and after retirement. We invite you to schedule a complimentary consultation with our team by giving us a call, sending us an email, or visiting our website today.